my name's Steve Allender. I'm one of the senior tax managers at Shorts. So I'm going to be looking at business structures, the difference in tax and accounting compliance for each. So when you're setting up a business in the UK, there are effectively four main ways that this can be done. Each has their own various tax and liability implications for the owners and shareholders. So the first one is a company, sole trader, partnership, and a limited liability partnership. So going through these individually, a company, that's actually a separate legal entity. So the company in its own rights will have to complete annual corporation tax returns, accounts and confirmation statements, which are submitted to Companies House on an annual basis. The company, any profits or losses, profits are subject to corporation tax, currently at 19%, and any retained profits after corporation tax has been paid, any salaries paid to directors, that pot of money is available to be distributed to shareholders of the company via a dividend, and that's effectively how business owners are remunerated, salary and dividends. And dividends are subject to income tax for the shareholder, but there's no NIC, national insurance contributions on those dividends. The benefit of a company is that the financial liability of the company is limited to the shareholders only to the amount that they agree to pay for their shares. So if the company is set up with £101 shares, for example, the shareholder pays £100 to that company, and that is the extent of their liabilities for the company's financial position. If you're going to set up and run a company and the intention is that that company will hold key assets such as property, excess cash, then an alternative option is to actually set up a holding company above the trading company, and then key assets of that trade can be moved up the chain to the holding company, and that has the benefit of de-risking those assets from the trade activities. The other alternative is to run the business as a sole trader. So that's somebody who runs a business individually. They would complete an annual set of accounts showing the profit or loss of that business and declare that on their individual tax return. Any profits are subject to income tax and national insurance through the self-assessment tax return. That individual, unlike a company, is responsible for all liabilities of the business. There's no limited liability status with a sole trader. Partnerships and limited liability partnerships, or LLPs as I'll refer to them, they're effectively the same with a few key differences. But in general, both of them is a business that is run by two or more individuals. So you can have a partnership with one individual. The partnership has to complete a set of accounts. It will prepare a partnership tax return, which is separate to the individual tax returns. And the profits and losses of those partnerships are then split as agreed between the two or more partners, and those profits or losses are then declared on their individual tax returns. And similar to self-employed individuals, the profits of their share of the profits of the partnership are fully taxable and subject to national insurance. And that's a key difference between a sole trader partnership and a limited company, is that as a partnership or sole trader, you pay tax on all your profits, irrespective if you take that money, whereas a company, you can control the amount of money that you take out of that business and therefore are subject to tax. Now, the key difference between a partnership and an LLP, under a partnership, very similar to a sole trader, they're effectively liable for the whole of the partnership's liabilities, and also any other partner's negligence or misconduct. And limited liability partnership, the key difference there is very similar to a company. The partner's liabilities are limited to the amount that they invest in the business in the outset. And also as well, financial accounts of an LLP need to be submitted to Companies House. So there's a public domain information available on that as well. Other key compliance requirements for setting up a business, whether that's any of the four that we've been through. VAT, so that's if taxable supplies are in excess of £85,000. Then the business will need to register for VAT and add VAT to future sales, but also be able to reclaim VAT on purchases as well. Pay-as-you-earn scheme, so that's when the business employs individuals, employees or directors. If it's a company, then the company or individual sole trader or partnership will need to register pay-as-you-earn scheme with HMRC and pay over tax and national insurance on a monthly basis. And as a knock-on effect of having a pay-as-you-earn scheme, the business must also have a pension auto-enrolment scheme as well, and that needs to be available to all employees, and the business will also have to contribute on behalf of the employees. The only exception to that is if an employee decides to opt out of that pension auto-enrolment.
Hi everyone, I'm Gary, the director of our Genus team here at Shorts, and this is a presentation on utilising finance to support growth. So a lot of clients ask, how do I use an FD or the wider finance team? So I'm going to cover three things that will help answer this and hopefully show you how to get value during that growth stage of the business. Now, these three things are systems, reporting, and having a sounding board. So let's start with the first one then, and we'll look at systems. So it's crucial from day one to set up with the best systems. This will allow you to grow with the least amount of pain. And also when you come to exit the business, this will help drive a higher value because it's organized and it's easy to find information, and you've got the historical trends there. Also, as a new startup or growing business, the one thing that is in short supply is time. So really ensure automation as much as possible, particularly on those back office procedures, particularly in the finance function. This will really give you the time and the space to actually add value to the business and work on those areas that you went into business to work on. And also, the systems need to work for you now and be scalable. So something like Xero that acts as a finance hub with operational add-ons is absolutely perfect. So let's look at the second point for today, which is reporting. And number one on reporting for a growing business is do not be a slave to the numbers. Yes, the financials are so important, but you have to build a reputation and a solid foundation as a priority. Now, by no means ignore the financials, though. This isn't me giving you permission to just completely ignore anything financial. Every decision should be considered for the financial impact. And also, don't measure and report on everything just because you can, or because Google tells you these are the top KPIs for a business in this particular industry. You need to decide what will make a real change to your business and help you achieve your goals, and measure that. If a KPI is not supporting you to achieve one of your goals and objectives, then it isn't really a KPI, it's just noise. And you want to be in a position of having a dashboard of key metrics that really get to the heart of what is happening within your business. And once you've got to that point, look to report backwards on the historical information, but also look to report forwards on forecasting and the projections on what we think will happen. So yes, the historical results are good. You need to know them, but you want to grow. So it's equally as important, if not more important, to focus on where we are going and where we want to be. So have a budget and report on this. And just to finish on reporting, basically any reporting that you're doing, it needs to be insightful. Which brings us on to my third point, which is having a sounding board. So really this is about surrounding yourself with the right people. So you may have heard of strategic business partnering. Well, this is my interpretation of that, really. Basically, you don't start a business to be an expert in everything. So don't try to be. Surround yourself with people that you can bounce ideas off, and doing this, it's always going to lead to a better outcome. You know, you say things out loud, you get somebody else's opinion, you tweak it, you change it, and then it just builds from there. Also, have a plan and a strategy to execute it. This can work as a reference point to help you make decisions, and it should start with what you want to achieve personally, and then from there, how the business helps you do this, and document it. So we use Lucidity. It's a nice slick piece of software that acts as a strategy platform, and it's there, it's intuitive, and if you've got something like that, you're more likely to look at it and stick to it and achieve it. And then also on having a sounding board, get people to hold you accountable and be honest with you. You know, a top sports person doesn't reach that top level without a good coach. It's exactly the same in business. Utilize the knowledge and support of people around you. You know, find either someone, or it might be different people with different expertise in different areas that can really support you along your journey, that can hold you accountable to what you say you want to do and work with you to actually achieve it. So very quickly to end on, this is the structure of a finance team. Now, looking at that, that's a big finance team. An SME would usually just dream of having this level of support internally. You know, this is what we'd expect at a large PLC. So this is exactly why the Genus team at Shorts was designed. The idea is to give SMEs that support and that insightful knowledge that a finance team can deliver. So our Genus team look to fill as many of these roles as is required for that business and provide the guidance on the areas we have just spoken about throughout the last few minutes. So really, just to summarize then, we've spoken about three things: systems, reporting, and having a sounding board. Now, if you cover these three things, that will enable you to utilize finance to support growth. Thanks very much.
Hi, I'm Darryl Hoy from Shorts Wages team. I'm here today to talk to you about R&D Tax Reliefs. Shorts, we're local accountants in Sheffield, so we're really keen to help companies in the area claim their full entitlement to generous tax reliefs. And that is one of the reasons why we partner with Sheffield Digital, as well as the Sheffield Chamber of Commerce. So the R&D Tax Relief is quite an old scheme now, introduced back in 2000 to incentivise companies to innovate using the tax system. It's a scheme that's gained more popularity, but it is still underclaimed. R&D Tax Relief, it can be claimed by qualifying companies, so most SMEs will qualify, but you have to be an incorporated company, so not a sole trader or individual, and incurring qualifying expenditure. It's on a qualifying project, and that's quite the trickiest condition to meet, which I'll talk about later. But the biggest barriers to claims we found is that companies don't think they're innovative enough to qualify and underplay this. There are two schemes available in the UK. The main scheme that we see is for the small medium enterprises, but there is a scheme for larger companies or SME companies who might be receive of grant funding. So a qualifying project aims to achieve an advance in science and technology through the resolution of scientific or technological uncertainties. These projects need to seek to create or at least appreciably improve a product or process, or in technology companies, software. There has to be an advance in all the science and technology, and not just the companies. So companies trying to play catch up or copying what's available in open source is not going to qualify. But if there's a genuine advance where there's no known public information available, then there's a high chance it will qualify. Most sectors will qualify, but predominantly the manufacturing and technology sectors are the ones that submit most claims. The guidelines that we work to were put together by HMRC and the Business, Energy and Industrial Strategy Department, which formerly was the Department of Trade and Industry. There's triggers for R&D claims, and typically what we will look for is companies that have technical staff solving technical problems. Companies that hold a market leading position or have patents are a key indicator as well. Technology companies raising patents for software is a bit more difficult because of the way that software moves so quickly, but we have seen some companies that do hold software patents. Making modifications to processes also qualifies, and developing new products is actually a key area where R&D is often evident. For software companies, particularly writing bespoke software, it is obviously where it's most likely to be R&D, and there we're looking for how it's been done rather than what has been produced for a commercial project. And it is often, it can be brown coat development, just not white coat people, white coats working in laboratories, for instance. The big focus is on technical advance and resolving technical uncertainties. So how does it work in terms of relief? Well, this example will just talk through what it could be worth to a company who's making an R&D claim. So in this instance, a company spent £100,000 on staff wages and raw materials. And they pay corporation tax at 19%, which is the current rate. The £100,000 they've already spent on those labour and materials costs would be expensed in their profit and loss account as normal and showing the accounts. But what the R&D scheme does, it allows for an extra 130% deduction on top of that for the money spent on R&D. So in this instance, for £130,000, the £100,000 spent would give an overall deduction of £230,000. So the extra £130,000 that we've identified at 19% gives a tax saving of £24,700. Which is really generous scheme, and if you think about it, you know, in terms of making a claim, that's an easy way to raise some cash for the money. And how many sales would you need to really generate to create that kind of money? 100,000 is just a figure we've used, but obviously, and not quite often companies might not be spending as much as that. But certainly, the scheme is a really generous scheme. How to claim? Well, the claim has to be made on a corporation tax return alongside your tax computation and a set of accounts. Although it's not mandatory, an R&D technical report should be submitted as well, describing what the R&D projects were, how the advancing science and technology has been made or attempted to made, and the breakdown of the costs that you've incurred on each of the qualifying projects. You have 2 years from the end of your accounting period to make a claim. So if you had a 31st of March 2020 year end, you'd have until 31st of March 2022 to make that submission. In terms of the process of preparing claims, it should be straightforward and unburdening for the business if you're working with a specialist R&D advisor such as ourselves. How we like to work is we normally have an initial discussion with the business, which lasts between 30 to 60 minutes. And here we can talk about the projects that might qualify and what the process is. And if we're all happy that there are some R&D projects to make a claim for, we'll then sort out the engagement and hold a technical meeting with the technical people. So that's normally the key competent professionals within the business. So that will be the software developers who have been heavily involved in the project, or the manager, or maybe the director of the company. That meeting will probably last maybe 1 to 2 hours, but that really is probably going to be the main part of the process for you. It will take most time, a couple of hours of time. And then we'll then work and pull the report together into a technical document with all the costs included, which is then shared back with the business to make sure it's all materially correct, you're happy with the claim. We then get that claim submitted to HMRC, and then normally within 28 days a claim is processed by HMRC and the money's in your bank account. So a very streamlined process. And if you want to get in touch and talk about more, the contact details are there. We'll be happy to discuss how we can help you. Thank you.
Hello, my name is Martin Dean. I'm the Corporate Finance Manager at Shorts. As a bit of an introduction about myself, I've worked for Shorts for the best part of 8 years, primarily involved in helping our clients in sort of a variety of ways, really, including auditing, preparation of statutory and monthly accounts, development training and installations of accounting and bespoke cloud-based products for our clients. For the last 3 years, I've focused primarily on helping our clients purely from a corporate finance perspective. Putting simply, the sort of thing I do day to day now is buying and selling of businesses, fundraising and investment appraisal projects, including detailed forecasting, valuations of companies, and just general business exit strategy. So today I want to talk around two sort of key areas, really. Preparing for investment and fundraising for businesses, and preparing to sell your business. So hopefully both sections help you. And yes, thank you. So the first section I want to cover today is the preparation and investment and fundraising for businesses, particularly focused on the business growth side. So finding fundraising or investment for businesses that want to grow. So I'll just click onto the next slide to start it off. So in terms of preparation, the first question I would advise you need to ask yourself is, I need cash for my business growth plan. What do I need to do beforehand? So we've tried to break it down into sort of 5 key points. This is a very high level. There's a lot more detail to go into, but try to focus on the key things that the business owners should focus on. First point, really, really important. Have a clear plan and strategy. Focus on your USPs, so your unique selling points. What makes your product, what makes your service, what makes your business unique, and find solutions to mitigate your business risks. So fundamentally, make a plan and make sure it's as bulletproof as possible. So basically you've got a document of some sort to put together, to put in front of investors or funders that says, we know we've got a clear plan about what we want to do and where we want to take the business. It just really reduces the risk from a fundraising or investment point of view if you've got that clear plan. So it sounds obvious a lot of the time, but I think we see examples of individuals that have got really good products or services, but they've just not really got a clear plan about how they get to the point they want to get it to. So first point is to really focus on that. Second point, prove your plan is financially viable. So investors will want to know that fundamentally they're either going to get a return at the end of the investment period that they're investing in, or that their money that they're lending you, albeit they're going to be charging interest, is going to be secure for them. So preparation from a financial point of view is really key. So having management accounts and forecasts will help you identify how much you need, when you need it, and how that affects cash flow moving forward. So again, from an investment point of view for growth, it's really key that the financials stack up. Third point, take advantage of free money for innovation. So R&D claims, so research and development claims, grant funding, etc. Speak to advisors, speak to colleagues, peers about claims and funding, free money essentially that you could be getting for your business. Not only does it help cash flow, but it also proves to funders that you are exploring all options. So again, it adds to that credibility of having a clear plan and strategy. It gives funders and investors confidence. Ensure your books and records and contracts are robust and your IP is protected. So again, really key. Some bits may be self-explanatory, but contracts really important. If you're a business where contracts are key, having robust ones is really key. I can't emphasize it enough. Speak to legal advisors about making sure those contracts are robust, not only from an investment point of view, but if you're thinking of an exit strategy as well, having those contracts in place, and which means that your customers are tied in, is really important. So I've touched on there as well, your IP is protected. So if you've got a product, make sure it's protected, make sure you've got that IP protected. And finally, really, probably would say this as an advisor, but speak to us and speak to us early about your plans. It's that age-old saying, if you fail to prepare, then prepare to fail. It really is key, and it goes back to that first point, really, of having a clear plan and strategy. The more time and effort you focus at the beginning of the process, get advisors involved at that early stage, the better the outcome, essentially. So that's what we'll be doing in terms of preparation. What should we be doing beforehand? So next question really is, what types of funding are there for my growth plans? And what type of funding do I need for my business in particular? So I've broken it down to three main types of funding. So we've got equity funding. So think Dragon's Den. That's going to be an exchange of your shares for cash in that business. So if you've created a company, for example, you own 100% of those shares, you'd be giving up 9 times out of 10 a lot of those shareholdings in exchange for cash to really ramp up that business to the next level. Equity funders tend to look forward, so they're a lot more interested in the growth plans. So this is why it's quite a good type of funding if you think your business is really going to skyrocket and it's got potential to do that. And that's really what they're interested in. So often there are no cash outgoings or no cash outflows. So example, dividends. What the goal of investors from an equity point of view is to sell the business on the back of those growth plans being delivered. So it really is about having a clear plan, thinking that you're going to grow the business 3 or 4 times in the next 4 or 5 years, convincing a funder to buy into that plan. And yes, you give up a lot of your shares 9 times out of 10, but the idea is that the shareholding that you retain is worth a lot more in the future. So that's one type of funding. It's equity funding. Again, tend to look forwards, interested in growth. There's also debt funding. So this is what most businesses will consider sort of traditional type of lending. Debt funders tend to look backwards. So they're more interested in, can the business repay the debt that I'm going to put into it? So it's to do with serviceability of that debt. The main types of debt funding, so because most people think it's maybe going to the bank and just asking the bank for a loan of some sort, but there are also other types of funding. So invoice discounting, so that's typically funding raised on your debtor's ledger. So you essentially sell your invoice to raise finance. There's overdraft facilities, so tend to be less common these days, but they still are available. So if you've got one, that's good. Stock finance, fixed asset finance, and cash flow lending. I'll touch on those. But cash flow lending is a traditional loan that you'd be used to seeing. The other type of funding may not class as type of funding, but it is. It's family and friends. So for a lot of startup businesses in particular, tends to be the case that you're convincing your family and friends that you've got a fantastic idea. So getting them involved could be a type of funding, going out and asking them. some surplus cash or assets within the business as well. Can you sell a certain asset to fund the project that you're doing? Or have you got enough cash in your business that you don't want to take out as dividends that maybe you could use to invest in a project for your growth plans? So surplus cash within the business, really. And specialist government funding programs as well. So there are types of government schemes out there that can help from a funding perspective. So it's worth looking at. Okay. So what are the things to consider then, based on the types of funding that are available? The two main types, so to speak, the equity and debt funding. So what are the financial implications and non-financial implications of equity funding? So finding an investor can be very, very difficult. So they really need to be bought into your plan. They really need to believe it. And often, like I say, the second point there, they'll often want a really large stake in your business. They typically can be getting up to sort of definitely a majority stake in most cases. So over 50%, they'll want over 50% of your business. So think Dragon's Den. That's the sort of thing, that's the sort of investor you'd be getting on board. The idea would be not only would they want to invest in your business, they've also got a stake in it. So it can be really mutually beneficial because they may know a lot of other funders. They may be thinking of a buy in 5-6 years' time. So they just have a lot of contacts. So yes, you're giving up a large stake of your business, but you're opening up a lot of doors as well by getting an equity funder involved. And typically an equity investor will want to see evidence of a high EBITDA return, so 20% plus. So again, you've got to have a product or service that is generating a lot of return eventually. It might be loss making initially, or there might be an initial need for a lot of marketing spend that creates a loss. But essentially, an investor will want to see, well, when you switch that marketing spend off, is the return more than 20% generally? You can get investors that will take lower stuff, but they want really high return products and services. So what are the financial implications and non-financial implications of debt funding? So invoice discounting, I've touched on it previously, that it's essentially selling your sales invoices. They're not suitable for a lot of businesses, particularly if you don't raise sales invoices, you don't have credit terms with your customers. It just simply won't be applicable to a lot of businesses. But if you do have invoices, sales invoices, and they are on maybe lengthy credit terms, invoice discounting is a solution for you. Overdrafts, touched on, less available these days, and also they're tending to be quite expensive, so that's something to consider. Stock finance, similar to invoice discounting, you're getting lending on your stock essentially, so perishable items, non-perishable items, so to speak, tend to have a lower value, i.e. you're very unlikely to get the full amount of that stock finance, and it's hard to obtain unless you've got very high levels of stock as well. Fixed asset finance, so this is to do with your assets that you have on the balance sheet that you may have initially bought out of cash, or you may have on finance, but you're coming to the end of the term. You can look to refinance that essentially to generate some cash for any growth plans that you've got. And the last one is cash flow lending. So implications there is it's not ideal for startup companies. Lenders, as I've touched on, tend to look backwards for proof of serviceability. So often they require a personal guarantee. They tend to be expensive to offset the lender's perceived risk. So you may not, there is a second tier lending market out there, but interest rates tend to be getting towards a double-digit figures if they're looking to invest. And again, so not great for startup companies. You've got to be trading essentially for a number of years to successfully get a cash flow lend, or a typical bank loan as you would see them. So final question really, how do I find equity investors? Because that's often a question we get asked. First place really to start off with is your peers and colleagues in the sector. Often if you're creating a product or service, you've developed that with colleagues and peers. You may have a competitor in some sense, or with some synergies. So I'd say speaking to them, really, speaking who they're sort of talking to, is a good place to start, because often they'll have an end user that's interested in their product. So, you know, attending seminars, networking events, just encouraging that networking is what you can actively do to get in front of equity funders and get your product out there. But it goes back to the first point of having a clear plan and strategy, getting something together that really sells your business and your model. That's really important. So build your brand and get your name out into the market. So that's the whole point, really. Get out there, get networking, attend events, seminars for, you know, specific to your sector, and a lot of doors will start to open. And also, how do I find equity investors? Speak to advisors. Again, we would say this, but we use specialist software that identify investors, which often helps. We've also got experience both locally and nationally, and we've also got a client base of high net worth individuals looking to invest their money in businesses, particularly businesses with high profitability. So that's the end of this section. Hopefully it's been helpful. Very high level, again, very hard to put everything into a 5-10 minute presentation, but hopefully it's been of help. And please feel free to get in touch if you've got any queries.
Hi, I'm Darryl Hoy from Short's Wages team, here today to talk to you about R&D tax reliefs and how they affect technology-based claims. Short's, we're a local Sheffield-based company, really keen to help local companies take advantage of this generous R&D tax relief scheme, as well with proud partners of Sheffield Digital. So R&D tax relief was introduced back in 2000 to help incentivise companies to innovate using the tax system. And the claims can be made by qualifying companies, and they has to be incorporated limited companies. So most SMEs will qualify who have qualifying R&D expenditure. The R&D project is one of the tricky conditions to meet. One of the biggest barriers we've had with companies think they're not innovative enough and underplay how innovative they are. We have relief available under two schemes, which is the SME scheme for small medium enterprises, and there's a scheme called RDEC, which is for large companies, or sometimes SMEs that are receiving grant funding. So qualifying projects for technology companies, but for all sectors, have to achieve or try to achieve an advance in science or technology through resolving scientific or technological uncertainties. They have to seek to create or appreciably improve that product. And there has to be an advance in all of science and technology, not just for companies. So when we're looking at software and software engineering, that would be the field to measure the advance against and what the current state of knowledge is and how you're appreciably improving that or the advance. So it applies in any sector, but technology and manufacturing companies are the ones that submit those claims to HMRC, and these claims are produced in line with the guidelines from HMRC, which are written by the Business, Energy and Industrial Strategy Department, which used to be the Department of Trade and Industry. Triggers for R&D claims that we look for is technical staff undertaking technical problem solving. So here this will be your key software developers who are involved in doing development of software. Sometimes as well when if companies holding a market leading position or have patents, although I appreciate having a patent on software can be quite difficult. So it's where where new software is being developed or produced, technical staff doing challenging work, bespoke software being developed, and here we're looking at how that software has been developed rather than what the commercial end product is for, and also making modifications to the software. But the main focus is on the technological advance and resolving technical uncertainties within that project. So examples of qualifying R&D projects that we've seen in software claims, we've seen some development in location and mapping technology and creating new apps, blockchain and Bitcoin platforms, some photo recognition, visual searching software, lots of bespoke algorithms being developed, particularly for sort of CRM, ERP systems, waste management systems, factory management systems, barcode scanning development, where it's been integrated into different platforms. New codes we've been implementing AI and machine learning techniques, sort of very new sort of kind of technology. First generation API data structures, and again, integration of different APIs, multiple APIs, often involves some quite tricky bespoke coding, and unique ordering, again, stock warehouse management systems. We're also seeing quite some development in sports venue platform, where it's involving all the security protocols, particularly with COVID at the minute, and introducing a digital process to pull all those different regulations together so it can all be recorded in a really streamlined manner. So lots of things that are going on, but really the message is really if you're developing some new software that is seen as a step forward to what currently exists, then the high chance that would qualify. So key points to consider within software engine is in terms of what advances to a technology are you attempting to create. And the focus really needs to be on that technical input that requires that step forward, rather than the actual commercial output to that end user. It might be bespoke, but again, consider if you're still using existing developer frameworks and languages like JavaScript, SQL databases, that kind of area. What tools are you using to create this new software? And really, to qualify for R&D for tax purposes, you have to be looking to extend these kind of systems and frameworks beyond their existing capabilities, and creating that new knowledge and methodology. So a good way of measuring this is to look at what existing baselining technology is at the start of a project, what's available in open source, and how is it that you're trying to advance that technology forward. You could also look to measure against a comparable family or suite of products that's sort of seen as the current state of knowledge. What technical changes have you been trying to make? But making an appreciable improvement to that, as long as it's not a minor or routine modification of optimization, that would qualify. And we often see that the answer will be where that software has been extended beyond its existing capability to make it quicker, more reliable platform, and quite often cost will be part of that as well. So it might be that you could buy an off-the-shelf system for a lot more money, but actually that's not going to be within the budget. So you're actually trying to create something that's as good or better than what currently exists, would cost a lot more to buy. So it's how you're doing that. And again, looking at as well new security protocols, creating new security platforms, and how that integrates within the system, and system uncertainties that might be involved in embedding that into these systems, that would qualify. So all of these starts, in terms of the activities with developers, when those developers start to resolve the technical uncertainties. So technical analysis in relation to these technical uncertainties would qualify, but not the business requirement gathering that often goes on before the project starts. Technical planning, design and development that attempts to resolve uncertainties would all qualify, and the testing that feeds back into the development, but not user sort of testing that sort of validates how it works. And again, quite often you'll see that, within sort of the sort of big developments, you'll be going back and testing small units of code and how it's working with integration, and that kind of area of the early beta sort of phase testing should qualify. It's just that user and functional testing that wouldn't normally be deemed as qualifying activity, even though it is a part of a bigger project. So in terms of how we can help, it's short. We know that HMRC have tightened the threshold of what constitutes R&D on software, and has some specific guidance as well on the HMRC website that's specific for software, with some examples which would be worth a read. And we could point you to talk you through that guidance if you would contact us. In terms of how we help, we generally as well would have a 30 to 6 minute consultation with you to talk about what projects you're doing and do we think they qualify, and then measure that against that current software and discuss that. It's key that once we've identified projects, that the key technical staff involved in the projects and involved in the preparation of the claims, they're none of the best placed people who can identify what the challenges have been and what the technical uncertainties have been within the project. Bearing in mind that software and the manufacturing companies make up 60% of almost all claims HMR receive. So if you're a company that's developing new technology, there's a hard chance that you should be claiming, and if you're not, please get in touch and we can help you through that process. And there's our details to get in touch. We'd be happy to talk to you. Thank you.
Hi, I'm Steve Allender. I'm one of the senior tax managers at Shorts, and today we're going to be talking about incentivising staff and tax efficient funding for startup businesses. So there are several ways that you can actually reward staff and incentivise staff. The first one is, and these are limited, there's a lot more, but the first one is a straightforward bonus, and that's just paid via the payroll, and is subject to tax and national insurance at source, and the employer's national insurance as well, and the employee receives that in their net pay. You can provide taxable benefits to employees, so things like private medical, cars. They're all ways of incentivising staff and adding to the remuneration package. There are benefits in kind issues there. Basically, the employee would be subject to tax on the benefits in kind value on that taxable benefit, and the employer would have a national insurance charge as well. There are benefits that can be provided which are tax-free, things like mobile phones, childcare vouchers, salary sacrifice schemes, so where salary is reduced in lieu of pension contributions, so it provides a bit of flexibility. And finally, as well, one thing I also wanted to mention is trivial benefits. This is where the employer can gift something of value of up to £50 to an employee, so such as non-cash vouchers, and that's completely tax-free. The only proviso is that that's not a reward for services, so it's a Christmas gift or a wedding gift or something like that. This is about share schemes, so this applies only really to companies. So this is where key employees want to be rewarded with shares within the company structure. And there are various ways of doing this, and I've touched on a couple of here, which are EMI schemes and company share option plans. Now, under these schemes, which can be approved by HMRC, so what that means is that there's key tax benefits provided under these schemes. These, an EMI scheme allows an employee to effectively have a grant of an option to purchase shares at a future date, depending on certain criteria, such as the performance of the company, or if the company is going to be sold. Company share option plans. This is where an employer can grant share options of up to £30,000, and that's open to all employees or full-time directors. So these can be real key incentives to certain key staff that you want to retain within the business. Growth shares as well. These are basically where a new class of shares is created within the company, and those classes of shares have special rights attached to them, and those are gifted to the employee, or they're sold to the employee. And these give a right to capital on a future sale over a certain permitted threshold. So it encourages the employee to work hard to effectively share the wealth on a future disposal. Tax efficient funding, again, these are aimed at companies. So these are startup companies where the government introduced schemes that encourage investors to help to put money into startup companies, and the carrot on the end of the stick in these cases is tax benefits. And there's three key schemes available for this type of funding. There's EIS, which is Enterprise Investment Scheme. So this is where an individual can invest up to £1 million, and they will receive a tax relief of 30% on their investment, which is pretty generous. Any gains on the future sale of those shares under an EIS scheme are tax-free if they're held for a 3-year period or more. And there is also a CGT, capital gains tax deferral, available for these. This is where if any asset was sold and the proceeds were used to invest in the EIS shares, then the gain on that previous disposal can actually be deferred until the shares in the EIS scheme are actually sold. So there's a deferral scheme available on those. VCT, this is a venture capital trust. The investment isn't as high, it's 200,000, but the income tax relief remains at 30% like an EIS. Dividends are tax-free, as is growth within a VCT. There is no CGT deferral available on a VCT, unlike an EIS scheme. And also with a VCT, there's a 5-year minimum holding period. So if the shares were actually sold within this 5 year, there's a clawback of the tax relief, this 30% relief that was given when the investment was originally made. And finally, there's a CEAS, which is a Seed Enterprise Investment Scheme. The limits are not as high, but the reliefs available are a lot higher and a bit more generous than an EIS and a VCT. So the investment on this one is limited to £100,000. But the income tax relief, rather than 30% on the others, is actually increased to 50%. And rather than a CGT deferment scheme, this has a CGT reinvestment relief scheme, which basically says that, again, if an asset was sold and the proceeds were used to invest in a seed EIS scheme, 50% of the gain on that previous asset can actually be completely exempt from capital gains tax. So it's not a deferral, it's an actually exemption. So a lot more generous reliefs, but the limits are reduced. Thanks very much for listening to this presentation. I hope you enjoyed it and found it useful.
Hello again. In this second section, I want to cover briefly about preparing to sell your business and how to do that. So it's not an exhaustive list. Preparing to sell your business, it's not something that you can really cover in 5 to 10 minutes, but we want to focus on some key things that you should be thinking about. So you're thinking of selling your business, you've built it up to a point. Hopefully you've had this plan from the very start. Very key to talk about that, really. Having an exit strategy in mind from day one is really important. So we'd encourage that as a point to start off with. But we're assuming you've got to that level where your business is of a point where you can come to sell it. What are your options? So there are 3 main ways to sell your business. There's a trade sale, so selling your business to either another business or private equity. There's a management buy-in or buy-out, so often overlooked by businesses, but assuming you've groomed your business up to a point where you've got a very good management team in place, often that management team will want to take on the business. They'll want to buy your shares off you, and there's a fundraising exercise there that can be done to allow you to exit. So that's strategy 2. Third strategy, it's more popular these days. It's a fairly new scheme that's come into place, but it's exiting your business via an employee ownership trust. Similar to a management buy-in buyout in principle. I'm sure the tax guys and the tax slides will go into this in a bit more detail, but it's fundamentally selling your business to a trust for the benefit of all your employees in the business. So rather than a management buy-in or buyout where it's maybe a small group of people that want to take the business forward and own it, an employee ownership trust is essentially all your employees will become effectively owners of the business through a trust. So how to maximize value? That's sort of a key sort of point really that most clients come to us with. So I think the first point is to understand, develop and protect your value drivers. So removing any non-business assets, example, investment properties, cars, just getting those out as part of the sales process first is quite key. Protect your IP, so intellectual property. So if you've got a unique product that is driving your growth, your business model, make sure you protect it. Really, really important. That somebody else can't just come along and copy what you've done, copy your business model. Someone with deep pockets can come along and think that's a great idea, I'm going to do that, rather than buy your business. So protecting that IP is really important. Third point, really, really important actually, tie in your key management. So hopefully you've got to the point where you've groomed your business in the right way. You've got a management team do the majority of your tasks as a business owner. Tying them in with robust contracts again is really important when you're coming to sell your business and to maximize value. Ensure your customers are under contract, if applicable. Not applicable to all businesses, but really key if it is that your customers are under contract, robust contracts again. Speak to legal advisors about ensuring your contracts are robust, and the longer the term of those contracts, the better. But again, it's got to be applicable to your business. Number two, making your business less reliant on you as a business owner. So again, sort of ties into point three, tying in your key management, but passing on that customer-client relationships, that can be hard for business owners, but it's really key when you come for exiting your business, that a buyer will want to see that you're not driving the business yourself. If you walk away, then suddenly the customer relationship, the client relationships go with you. So it's really key that you start encouraging sort of low management team below you, that they start building that customer and client relationships. Obviously, you've got to manage it. You don't want them to go off to maybe a competitor and them to go with you. So that's all about incentivizing your employees as well. But fundamentally, passing on those relationships so that you can step back and make the business less reliant on you is really key. Similarly, ensure technical knowledge is spread around the management team. So similar to passing on client relationships, really, you're passing all your knowledge on to somebody else. From a buyer's point of view, they're investing in the future, not you when you exit. And again, aim to go part-time if possible. I think that's every business owner's dream. I think it can be difficult when you've built a business up to let go of control. But again, if you've got the right team around you, the right individuals running the business for you, that seems like a good thing to do, is to aim to go part-time. And again, from a buyer's point of view, your involvement in the business, the less important that is, then the more they're investing in the team that are already there. Okay. Good housekeeping. So again, really important, particularly when you go through due diligence exercise, that tax filings are up to date, everything's on time. You really need to keep on top of that. Don't let VAT returns slip or statutory accounts filings slip, because from a buyer's point of view, they may want to price ship when it comes to negotiations, but also they want to be investing in a business that's well run. So ensuring those sort of things are up to date is really important. Customer suppliers contracts are robust and signed off if possible. Again, touched on it already, but really enhances the value if you've got suppliers and customers under contracts that suit you. Employee policies are up to date. Again, gives the perceived value that HR is up to date. Really important for a new buyer coming on board. Those sort of policies are up to date. And another sort of key point: settle any minor legal claims. We don't want to make a buyer nervous if we've got a claim, somebody's, there's an accident at work or a customer's trying to sue you for something. Get those claims settled so that there are no gremlins there when a buyer comes in. Because again, they'll either view it as a risk to them as an investment from a buyer's point of view, or they'll simply use it as an excuse to price chip. So settle any claims, really important. And fourth point, good information. So monthly management accounts, really encourage that you do that. Again, it's the perception that you're monitoring information monthly. And also when it comes to due diligence, a buyer, if you've got monthly management accounts, it's a lot easier for a buyer to analyze the figures and really get comfortable with what they're investing in, and which will enhance the valuation, the price that they're going to pay. So an example maybe by splitting your sales and profit by product and customer, having that in place. So really being involved in the financials, maybe not doing the day-to-day, but having an understanding of what drives it. A lot of business owners, they know what the profit is in their head, but from a buyer's point of view, they want to see that and analyze it. So having that split, making sure you've got the right accounting software in place, the right team running the financial side is really important. And putting it simply, selling your business is like selling your home. So, put yourselves in the buyer's shoes and be self-critical. That can be quite hard for business owners, but it's quite key. And again, if you're selling your home, you'll make sure it's tidy. You'll make sure the dishes are done. Everything's in place to really maximize that value. So that's what we're trying to do here. There's no different in selling your business. So on to the next slide, preparing your business for sale. So we boiled this down to sort of 5 key points really. Again, emphasis is on maximizing value. First point, start early. So start that process early. Hopefully you've had a strategic plan all along where you want to sell your business. That's really key. I would say that's the first thing to sort of focus on. Emphasize the positives and de-risk the negatives. So really look at your business and think, try and be self-critical, as I've touched on the last slide, and start that process early. The sooner you start it, the better, really. Number 2, find a strategic buyer. So this will often be your customers and suppliers. That's a good place to start. You can also engage with advisors like ourselves. We use a database and we have a network of acquisitive companies and investors looking to buy other businesses. So again, the point being that you want a strategic buyer to maximize value. You want that buyer that really wants your business. So there are a couple of options that you can take from that point of view. Number 3, control the process. So really what we're trying to achieve here, we want to try and create an auction style process whereby we've got multiple buyers involved who want to buy your business, and that will maximize value. And really engaging with advisors avoids you being dictated to by the buyer. It's our job to take the stress away and do the negotiation on your behalf. So creating that auction style, hopefully we get to the point where one buyer really wants it, and ultimately they will have to outbid each other to get to that point. Number 4, prepare for detailed due diligence. So as touched on, this can be really, really rigorous for business owners, and it's essential. Every buyer will want to do due diligence of some sort. Some can be limited, some can be full scope. And fundamentally, they're doing it because they have to be happy with what they're buying. They won't just take your word for it. So again, it can be time consuming, this exercise. So it's really, really key that your financials and your operational systems are robust, and that actually you're well prepared for this process. You want to be effectively, you just want to run the business yourself, and having that process in place, everything, all your ducks lined up, so to speak, will just mean the due diligence process is a lot easier. And finally, point 5, prepare yourself emotionally for it. Selling your business is not easy. It typically takes between 6 to 12 months, which is a lot longer than most business owners think initially. The due diligence process, as we touched on, can be really, really stressful for business owners. So I'd say prepare yourself mentally beforehand, that it is going to be stressful. The more groomed for sale you are, the more prepared you are to sell your business, the easier it's going to be. So again, it's all boiling back to having a clear plan, having a clear strategy. The more groomed you are, the easier it's going to be. And the best way to take that emotion out, and to reduce the stress, is to engage with advisors to do it. We'll act in your best interests, but take the stress of the negotiation, the process away, so that you can concentrate on just running your business. From a buyer's point of view, that's what they want as well. The process of selling your business is, a lot of the time, you may have certain things that are confidential. You may not want certain members knowing that you're trying to sell your business. So all of a sudden, as a business owner, you may have stepped away and you're going to have to step back in again to make sure everything's confidential as part of the process. So by engaging advisors, that's our job, to help in that process. So that's the end of section 2. Hopefully I've been of some help. I suppose really the last point is, feel free to get in touch with any queries that you have, and thank you for your time.
Hello everyone, my name's David Robinson. I'm a tax director at Shorts, and I'm going to talk to you about preparing to sell your business with a focus on the tax aspects. As a business owner, one of the best things you can do to withdraw funds from the business is effectively to sell an exit. It can be very, very tax efficient compared to perhaps taking a dividend or a salary. And that's what I want to try and get across today, with also just going through a few bits around what to do before the sale, ensuring that you maximize reliefs, and then to cover how the consideration is taxed, and then just to go through exit options in respect of tax and how they work. So first up, if you are looking to sell and sell your business, what we always advocate as a tax advisor is to get your house in order. What we mean by that really is try and prepare your business for sale. So that does 2 things. One, it maximizes value for you on an exit, but also it can minimize the risk of a price chip or a deal falling over. For example, if a buyer finds something that it doesn't like in your business. So what do we do in terms of getting your house in order before the sale? Well, one of the things we can do is try and remove assets that you want to keep. So that might be property that's in the business that you want to keep personally, or a car, or some plant machinery or something like that. But it can also be, perhaps as a quirk of history, you've got 2 different trades in your business. So we can do something called a demerger. We can separate out the non-core trade from the core trade, which would be sold, and then that will nice and neatly package up your business for sale. If we do those 2 things far enough in advance of a sale, then we can generally extract assets or demerge a non-core activity in a tax efficient manner. So the more time you give us, the better, really. Secondly, on there, we've got incentivizing key staff. So if you've got some key members of your team that you really want to encourage and incentivize to grow the business, perhaps giving them something like a tax efficient EMI scheme, or some tax efficient rewards and incentives can really help them to encourage them to grow the business, which will ultimately give you more value when you exit. So it's always always worth looking at ways in which you can incentivize those key staff to grow your business. Third bullet point on there is make sure that you claim reliefs where available. There's lots of different reliefs that are available for businesses. Particular companies can claim something called R&D relief. So if you're doing something innovative, which I'm sure a lot of you guys are, then make sure you've checked out R&D reliefs and make sure you've maximized those claims, because the more claims you make, the more cash you've got in your business, the more valuable your business will be when you come to exit. Similar for capital allowances, which is the way that you get tax relief on capital expenditure. So for example, if you spent money on your property, or if you spent money on plant and machinery, you can claim those allowances, which reduces your tax bill and ultimately increases value on exit. Lastly, on this slide, just got final bullet point, which is all about leaving cash in the business prior to a sale. As I said at the start of the session, if you leave cash in your business rather than drawing it out as salary or dividends, that can be a really tax efficient way of ultimately getting value from your business, which we'll see on the next slide. Moving on then, so when you actually come to think about selling your business, you want to make sure that you, as a shareholder or as a business owner, will maximize the value that you get from sale and therefore minimize the amount of tax that you're paying on exit. So as a shareholder of a company, which most businesses perhaps might take the form of, when you come to sell your shares, generally you're taxed at 20% capital gains tax, which is the rate at the moment. However, there is a reduced rate of 10% if you qualify for something called business asset disposal relief. This used to be called entrepreneurs relief, which you may be more familiar with. So that's a reduced 10% capital gains tax rate that you can have on up to £1 million of lifetime gains currently. To qualify, you need to have at least 5% of the business, and you need to be an employee or director, and you need to have that for at least 2 years. So general conditions that need to be met. And one of the planning things that we look at regularly is to try and share ownership around family or friends or other business partners, to make sure that you have lots of different £1 million lifetime allowances to maximise that relief. The final 3 bullet points on there, something that's slightly less known, is something called a substantial shareholding exemption. And it's worth thinking about if you are going to reinvest your proceeds post-sale. So for example, if you have a holding company and a subsidiary, if you were to sell that subsidiary company, provided certain conditions are met, effectively that sale can be completely tax-free for the holding company, which can allow that holding company to then go and reinvest the proceeds into the new venture. Moving on to how consideration is taxed. This is thinking about you as a personal shareholder selling your business. I'm not going to go through all of this slide, but I just wanted to kind of highlight that there are different types of consideration that you can receive on the exit of your business. That could be cash up front, could be loan notes, could be an earn-out. They're all taxed slightly differently. And I think the key message there is that if you are thinking about selling your business and you get offers for the business, it's important to take tax advice, because one offer might be cash, one offer might be an earn-out with cash, and they're taxed slightly differently. So you want to try and compare apples with apples. Finally, from me, I just wanted to touch on a few different ways that you could exit your business, looking at shares in particular, and just looking at the kind of tax aspects in general. So most business owners have come across a trade sale or a management buyout. The first one is where you sell effectively to a third party with a management buyout, obviously selling to your management team. Thirdly, on there is a transaction called a company purchase of own shares, which effectively allows a shareholder to sell shares back to the company as a way of exiting. Now, that isn't generally kind of recommended or possible for majority shareholders. But if you've got a minority shareholder that's exiting in full, then that can be a good way of allowing them to leave in an efficient manner. Finally on here, I've got a family buyout and an EOT. Just quickly on a family buyout. So if you've got a business that's family owned and the owner wants to pass on to the next generation, that doesn't have to be a gift. That could be a sale of shares, perhaps with some bank finance. And what that does is allow you to de-risk your investment and take some money off the table whilst also passing on the business to the next generation. That can be a real good tax efficient way to allow the family to have some money out. Lastly on here, becoming increasingly popular, employee ownership trust exits. There's enough content there for a seminar on their own, but effectively, if you value succession and legacy and want to pass the business on to your employees, you can sell the business to an employee ownership trust, which is set up for the benefit of all the employees, so they participate in the kind of underlying value of the business forever. Key benefit for a seller is that as long as conditions are met, then your sale to an EOT can completely be free of tax, so completely tax-free, which is a very, very powerful and efficient way of selling your business and passing it on. So that was just a whistle-stop tour of some of the tax aspects to think about when looking to sell your business. I think from me as a summary, it's important to just get some tax advice when you're thinking about it and also when you actually get to the exit. Thank you.